Hi everybody, this is James Tompkins and welcome to Internal Rate of Return. So, first of all, there are a couple other nuggets I recommend you watching first. Number one, what is the asset investment decision, which is also known as capital budgeting. That's essentially what a company spends its money on. So, for example, when Apple decides to come out with a new iPhone, do they need to hire R&D people and researchers and designers and so forth? They do, right? So that's an example of an asset investment decision. And also understanding net present value. You'll need to maybe look at that nugget. And of course, there's always the option to look at the whole playlist, which you can see is on my channel. So what is internal rate of return? Well, first of all, we'll start off with some cash flows that I'm assuming. So for example, maybe I'm investing in my lemonade stand, or Apple's investing in a new iPhone or whatever. Okay, so they need to spend money, and then when they spend money, they hope to make money in the future. So imagine these are the expected cash flows. And then imagine the market looks at the riskiness inherent in the asset investment decision. They go, all right, well, we require a return of 10% to, if you will, induce us into being willing to invest in this risky investment. So here are the relevant cash flows that I'm assuming, and here's the discount rate. So what is it? Well, basically, let me ask you this question. If I took all of these future cash flows and I brought them all back to time zero, okay, using time value of money principles, and then I subtracted 10,000, conceptually, does there exist a discount rate that I could use where my answer would be zero? Well, conceptually that exists, right? And that would be the internal rate of return with one little wrinkle, and that is that it's annualized by convention. So, just to illustrate, here's my minus 10,000, that's already at time zero. Here I have an annuity of $4,000, so I'll use my annuity formula. And then finally I want to bring this guy back to time zero. And so there exists a number, internal rate of return, a discount rate that I could put in right there that would basically give me my internal rate of return, and then of course I have to annualize it. So basically, from time value of money stuff, it's essentially solving for R. So in this particular situation, if I put in the number 0.314, right there, and there, and got an answer of 0, which I would if you put in that number, that would be my internal rate of return. Again, with what wrinkle? Well, it's got to be annualized by convention. So for example, if these were 6-month periods, then this would be what kind of a rate? It'd be an effective 6-month rate, right? And if that doesn't make complete sense, you can go to my time value of money videos, and that should clear it all up. So if this were an effective 6-month rate, then what would I do to this number to communicate the internal rate of return? Well, I'd multiply it by 2, right? Why? Because there's 2 6-month periods in a year, and so just by convention, that's how internal rate of return is communicated. So that's basically what the internal rate of return is. If you want to get into more depth, like how would you apply it, how would it change your decisions, under what circumstance would you give it more weight versus other types of analysis or whatever, then stick around. But that's what it is, and that's how you calculate it. So what is the decision rule? In other words, what do you do with this number 0.314? What makes you say, yes, I want to do the project, or no, I don't want to do this project? And I'm going to tell you and hopefully get across some understanding about the decision rule, but I got to warn you, it's subject to pitfalls. And I'll be honest with you, when I graduated, having learned this stuff, all I'd done is memorize this decision rule. It wasn't until later I realized there was a little bit more to it. But let me try to get across the decision rule, okay? So basically, it sort of boils down to this guy, the discount rate, And just sort of a quick preview of what this guy really means is, is it fair to say that people are investing? I mean, there might be debt holders, there might be equity holders, and they're providing the firm with money, and then the firm spends money on, say, developing the Apple phone, right? And so the investors are basically saying, all right, well, what are you doing with my money? And are they going to provide their money for free? Well, they won't, right? If it's a debt holder, they'll charge interest, and that's their required rate of return of debt. And if it's an equity holder, they'll have a required rate of return, and so forth. And so basically they say, well, given what you're doing with my money, the riskier it is, do you think they'll charge more or less to provide their money? More, right? And that's basically what the discount rate is. If you want more depth, again, you can go to the discount rate for the asset investment decision in my video. But that's sort of a quick preview. And so they're saying, hey, this is the rate we'll essentially charge given the riskiness inherent in that. Okay. Now, if we look at the internal rate of return, what we've calculated is, well, you know what? We expect to actually yield even better than what the market's requiring. The market's saying, hey, given the riskiness of this is essentially what it's going to cost you. But because maybe we're really good at developing the iPhone, or I'm really good at having my lemonade stand or whatever, I expect to do even better than what the market requires. Now, is that happy face or sad face? If I can do better with my cash flows than what the market is essentially requiring. Well, that's happy face, right? And so what do I do with these two numbers to basically figure out, all right, yes, let's do the project, or no, let's not do the project? Well, basically, if this guy, the internal rate of return, is bigger than the discount rate, then I would do the project. So let's take it a step further. Let's look at under what circumstance this kind of analysis is useful. So let me go to this situation right here. Imagine I have two mutually exclusive projects. One's A, one's B. So what does that mean, mutually exclusive? Well, either I do A, or I do B, or I do neither. I just don't do both. So for example, if you were in the market to buy, say, a new car, you might say, well, either I'm going to get the Honda or I'm going to get the Toyota, but obviously I'm not going to get both. And I might even change my mind. I might just not even get a new car. So when it comes to A and B with the MPV, which one is the happy face? B, right? Because, their MPV is higher. And again, for what time period is this MPV? It's time zero, right? That's where you bring everything back to time zero. And what about the IRR? Given what we've just discussed, ceteris paribus, all else being equal, would you rather have a higher IRR or a lower IRR? Higher, right? So which one has the happy face here, A or B? A, right? So basically A, with the MPV, it's sad face, but with the IRR, it's happy face. And with B, it's the other way around. So what do? Do you do A with a lower MPV, but hey, higher IRR? Or do you do B? Well, if some of you are thinking, well, let's do A, we get a higher percentage back, right? Well, then imagine I'm the CEO, right? And I say, look, if I do A, I could put this much money in your pocket right now. And if I could do B, I could put maybe this much money in your pocket right now. Okay, I'm just basically getting across the point that if you do B, your share price is the value of your shares going to go up more or less than if you do A? It's going to go up more, right? So if I'm the CEO and I say, look, I could have put this much money in your pocket right now. This is how much your shares could have gone up by right now. But you know what? I'm just going to make a decision where it only goes up by this much. But hey, it's a 30% IRR. Well, are the shareholders going to care about that? They're not, right? They just want you to make decisions that make their share price go up as much as possible, right? And so basically, again, MPV rules. In other words, you would do B in this example. And so if MPV rules, then why bother calculating internal rate of return? I mean, what's the point? Why not just do MPV? Well, some of the textbooks are going to say, well, it's an easier way of communicating things, or maybe it's just another form of communication. But just because you communicate something differently, does that really change or can have an impact on your decision in any serious way? I would hope not. I mean, presumably you understand what different statistics or formulas are telling you, and then you use that as judgment to make decision. There's something much more significant about doing the internal rate of return that goes way beyond communication. So let me ask you this then. So here we have our asset investment decision. We spend 10 today, we expect to get all this back in the future, and then the project ends, and this is the discount rate that applies to the riskiness inherent in the project. And so when I'm calculating a net present value, what two pieces of information do I need? Well, do I need the cash flows? I do, right? Do I need a discount rate? I do, right? I mean, as we saw, MPV is basically bringing all of these cash flows back to time zero. So in this example, it'd be positive MPV, and we'd have an MPV of 6405. So with MPV, we need what two things? Cash flows and a discount rate. Well, what about an internal rate of return? What kind of information do we need? Well, do we need the cash flows? Well, sure. Do we need the discount rate? We don't, right? I mean, that's what we're solving for, right? I mean, here's the IRR. There we are using all the cash flows, but we're actually solving for a discount rate, which, when annualized, is our internal rate of return. And so sometimes, especially when companies are conglomerates or they're involved in a lot of different projects of different risks. So for example, Boeing is involved in both commercial aircraft as well as defense aircraft, which have very different risk factors. And FMC, the company I used to work for, involved in machinery that makes orange juice. Machinery that makes orange juice and agricultural chemicals, and they make or used to make the Bradley fighting vehicle and so on and so forth. And under those circumstances, it can be extremely tricky to figure out this guy. It can be very tricky to figure out the discount rate for a specific asset investment decision. And so if you do an internal rate of return, and you have enough experience working with this stuff, you can look at that and you can see, well, it's so high, clearly you're going to be in positive MPV territory. And so that's a situation where the internal rate of return can be very useful. And basically it saves you from trying to figure out a discount rate. And if you're in territory that's high enough for you to know, well, clearly this number is going to be bigger than any discount rate, then you can feel comfortable that you're in positive net present value territory. So now we've gotten into what internal rate of return is. Now we've gotten into circumstances under which it's useful. We have also talked about the decision rule. And what was the decision rule again? Well, basically this guy is bigger than this guy. But like I said, it's subject to pitfalls. So let me go through those pitfalls. So what is the sign of a typical asset investment? So for example, when Apple decides to invest in a new iPhone, do they have to spend money to make money? They do, right? So is cash leaving the firm or is it coming into the firm? It's leaving the firm, right? So if I just make up something very simple, where the initial cash flow is negative, so cash is leaving the firm, and then it's coming back into the firm. So imagine, I'm spending $10,000 today. I expect to get $15,000 in the future, and then that's the end of the project. Well, what's the internal rate of return for that project. Well, it's 50%, right? Why? Because minus 10 plus 15 over 1, the number that I put in right there, the 0.5, that is what's the only number that's going to give me an answer of 0. So my internal rate of return in that example is 50%. And so in this circumstance, the typical decision rule applies. So in other words, any discount rate less than this 50% is going to put me in positive net present value territory. Okay? Well, what if the cash flow signs change? So for example, what if we get 10 today, and because of that, us getting 10 today, we no longer expect to get 15? And what kind of asset investment decision would that be, by the way, where a company has an inflow first, and because of that inflow, they no longer have, or they have an outflow later, or the equivalent of an outflow? Well, that would be a company selling an asset, right? So years ago when IBM sold their PC business to China, to Lenovo, was IBM getting money today for selling their PC business? They were, right? And because they no longer had that PC business, does that mean they were no longer getting money in the future? They weren't, right? And so that would be the equivalent, if you will, of this minus. So again, the IRR in this situation, it's the same number, right? If you have plus 10, minus 15, the only number I can put right there is 50%, I'm going to get a 0. And in that circumstance, well, guess what? Now things have completely flipped. Now, if the internal rate of return is less than the discount rate, so the discount rate would need to be bigger than the internal rate of return to be in positive NPV territory. So it's a completely different decision rule. So the question is, why does the decision rule change? Well, the best way I can think of in teaching this is an analogy. So when you go to a bank and you deposit money, in what direction is cash flowing? From you to the bank or from the bank to you? Well, if you deposit money, you're putting money in the bank, so the cash is going from you to the bank, right? And what about when you borrow money? In what direction is cash going? Well, from the bank to you, right? So here's sort of a diagram depicting that. Deposit and cash is going from you to the bank, borrow from the bank to you. So here's the question. Let's see if your views of whether you like high or low interest rates change depending upon what direction the cash is going in. So when you deposit money, ceteris paribus, would you rather have a high interest rate or a low interest rate? High interest rate, right? But what about when you borrow money? Now you'd like the interest rate to be what? High or low? Low, right? In other words, your views of the interest rate completely change depending upon what direction the cash is going in. And is that also true right here? When we change the direction of cash flows, I mean, right here, all else being equal, would we rather the IRR be low or high? Low, right? Because the lower it is, the more likely the discount rate will put us in positive NPV territory. And of course, the opposite is true when we have our regular conventional cash flows, where you spend money today and you hope to make money in the future. There, would you rather have a high or low IRR? High, right? And so the analogy is basically the direction, or basically the borrowing and depositing money with the bank, just to illustrate that the direction the cash flows go in are going to have an impact on whether or not you like a high or low IRR. So that's one pitfall. There's actually one more pitfall. Suppose there's more than one sign change. Okay, suppose we spend money today and we get money back in the future, but then money goes out again. Okay. Well, in this particular situation, if I put in the number 25% and 400%, I would get an NPV of 0. So here's the 25%, there's the 400%. In both cases, I get an NPV of 0. So now I have two solutions. And by the way, if there were another sign change, there'd be three solutions. I think some mathematician, Descartes, or some mathematician figured this out. Every time there's a sign change, there's another solution. So what do? What's the decision rule? Well, guess what? You're just going to have to plot it. And so in this example, if you had a discount rate that was between 25% and 400%, that would put you in positive NPV territory. So the main thing here is don't do what I did. Don't memorize, hey, internal rate of return greater than discount rate, yay, positive NPV. The whole point was just to illustrate, well, that's not always true. There's a little bit more depth. Anyway, I hope this was useful to you and hope to see you again. Take care.